Good morning, everybody. I want to start off by thanking you guys for taking the time to come here and listen to our presentation. My name is Rashid Assad. I am the Senior Analyst for the Consumer Staples sector.
My name is Jill Kushler. I'm a Junior Analyst. I'm Lauren Francis. I'm also a Junior Analyst.
I'm Alvin Morales, also a Junior Analyst.
So, like I said, we are the Consumer Staples sector, and I'm going to pass it on to Lauren, where she'll give a brief description of the sector and a brief overview of the current environment.
Okay, so consumer staples are basically essential products that people are unwilling or unable to cut out of their budgets regardless of their financial situation. They're considered to be non-cyclical with steady growth and low betas, and include items such as food, beverages, tobacco, and household items. Currently, the sector is experiencing a little bit of a slump, especially compared to the technology sector. This is primarily due to the Amazon effect, the declining power of brand as an economic mode, as well as growing input price pressures and shrinking gross margins.
So yeah, we just, this graph we brought in just to show the decline in EVO sales relative to the S&P 500 for the consumer staples sector. Or, I know this is discretionary, but it's the staples sector, and the technology one is actually on the rise. So we're gonna move on to give a brief overview of the different factors we took into consideration for our screening model.
The first aspect that we took into consideration was our top line growth, because consumer staples are heavily dependent on their sales. We brought in revenue growth, asset turnover expansion, working capital management. Secondly, we brought in bottom line growth, because our companies need to perform well and have their margins expanding. This consisted of gross margin, and net margin expansion. We then brought in our return on capital so that we can make sure our companies had a positive return on investment. We brought in return on invested capital, economic value, EVA spread, and then EVA expansion. And then finally, to kind of, as a safety measure, we brought in the risk associated with them to make sure that there were no underlying issues. We brought in Bloomberg, probability of default, short interest ratio, debt levels, and volatility of the stock.
And for valuation, we brought in economic value trailing 12-month sales and economic value EBITDA. And how we decided to rank these factors was on a 1 to -1 basis, where if the model suggested as a 1, it would be the highest ranking on that particular factor, and a -1 as the weakest in comparison to the sector overall. And now I'm gonna move on to walk through the Excel model itself. And here I just give a brief overview of different categories and the different sub-factors under each category. And I linked it so when we click the different category, it takes us right to where it is on the model. And as you can see by the model here, we brought in all the data for top line growth based on the Bloomberg data, gross margin, and we calculated it so we know that, we calculated EBITDA and EBITDA margin and margin expansion. Return on invested capital, we want to make sure companies are are positive with their investments, are not declining and losing money because of that, and we want to make sure that they're doing good on a risk basis. And we went on to move on from this to rank these factors. As you can see here, we have the 1 to -1 ranking, where we rank the companies based on these factors and what they rank overall. And we went on to do a regression, where we wanted to, using solver, where we wanted to max the correlation based on the different factors weighted out and them equaling to 100%. We told solver, based on these factors, which weights will give us the highest correlation. And we got it to be 89% for our correlation and 80% for R squared. And we allocated 18% to turnover, 56% to margin, 10% to return on invested capital, and 16% to risk. And from now, we also ran the model as a non-GAAP and also by individual sub-industries to see if we would get deviations or variations with our correlation and also our buy and hold sell list. And for our buy, hold, sell list, what we did was we took companies that were ranked above 0.30, and that the difference between their rank intrinsically and their rank valuation was higher, at least 20 or higher. So we want companies that are ranked higher than what the market's ranking them by at least 0.20. And for hold, we did companies that are ranked at least in the median or 0, and that have a difference between their intrinsic and their valuation of -10 or higher. And from these model and these calculations, we move on to the list where Albert's going to talk about our current holdings and what our final short list was.
Yes, so based off our list, you can see that these 6 companies they are currently in our stock portfolio, studio portfolio, and previous groups wanted to keep their portfolio diversified by sub-industry, just in case one sub-industry were to begin to fail. Not our whole portfolio would fall as a whole. And as you can see here, the 7 companies that are there are currently in our short list. So for the first 5 companies were ranked high intrinsically based off our model with low valuation. The next 2 companies, the yellow ones, the Philip Morris and Constellation, were overall in our model were ranked as a whole, but once we ran the model again through sub-industry, were ranked as a buy during each sub-industry. So I'm going to pass it next to Rashid to go into more depth of explaining the companies.
Yes, so just a quick thing to mention here is on the right, we kind of ranked our short list and our current holdings overall for valuation and for the different categories that we bring in, just to see how they perform compared to the whole industry. And after this, we went on to do a dividend discount model for each individual company in our short list, where our assumptions were for the risk-free rate, we tied it back to the 10-year treasury yield. For the market risk premium, we used the capital asset pricing model to get the discount rate, and we used the 10-year treasury yield for the risk-free rate, the capital asset or the implied approach for the market risk premium, where we took in the expected return on stocks minus the risk-free rate, and the expected return on stocks, which was the dividend yield of the S&P 500 plus the earnings growth, which was tied back to nominal GDP. And our beta calculation was a function of our debt to market cap, as well as the volatility of their their net margin standard deviation. So we wanted to we did a calculation where we took into consideration the debt to market cap and the net margin standard deviation. And if the formula allocated the beta to be above 1.2, we wanted to cap it at 1.2. We don't want companies to be above 1.2 because we believe the consumer staple sector is relatively safe and should be relatively around 1 or if not below 1. And now I'm going to pass it on to Albert, where he'll dive deeper into the dividend discount model and data tables.
So the next analysis that we based ourselves off of was the dividend discount model. We divided each company into separate own charts, and through the horizontal axis, you can see that we ranged it from 3.3% to 4.25% based off the long-term growth, and the vertical axis being its beta. And we decided we assumed the beta of 1.20, so we kept it in the middle of our chart, and we did worst case scenario and best case scenario, where the lower the beta being less risky, and the higher the beta being more risky. And since all the numbers are red, this shows that that trading price would be lower than its current trading price for Molson. And then as you go down through the companies, some rank the green numbers would be saying that the trading price is higher than the current trading price. So so you look down these companies as showing the chart of its red numbers and through green numbers. And then I'll allow Rashid to go back into his analysis of explaining through the earnings calls, analyst reports, and economic notes.
A quick note on the data tables. So yeah, like Albert said, we brought these data tables in just to give us a margin of safety of what the company would look like based on the dividend discount model if their growth rate wasn't as high. and if their beta was either higher or lower, they want to see how the stock price would look like, to see if how broad our assumptions are. Just a quick note, I want to go back to the chart, this graph ranking chart here, where based on our model, the companies on the fourth quadrant would be ranked cheaply. So the horizontal axis is what our model ranks the company on an intrinsic value, and the vertical axis represents what the market ranks the company on a valuation basis. So we want companies that are ranked highly on our model and low in the market to give that opportunity for investment. So now I'm gonna go and talk about individual research we did for our shortlist. And for our first recommendation, we suggest Constellation brand for our buy list to replace our current holding in Boston Beer. And the reason for this is that the company is ranked intrinsically higher in our model, and it shows prominent growth opportunities with its current investment in Canopy Growth, a Canadian cannabis company, as well as its improved sales in above premium brand beer, where the current environment in the beer industry is kind of in a slump. Beer sales are on the decline, so Constellation Brands has been able to hold up well in this aspect, as well as have more prominent and interesting growth opportunities for the future. And it has recently sold a low-end wine portfolio, which has given it additional cash to further invest and to work around and focus mainly on these high premium brands. And now I'm gonna pass it on to Jill, which will talk about Philip Morris and how we want to recommend it to replace our Yum China holding.
As Rashid said, we're going to be recommending that we replace Yum China with Philip Morris. This is to better include a diverse portfolio, so because we already have two Yum. So we're recommending this not only because of the high intrinsic value that we got from our model, but through further research, we found that while cigarette sales are down, e-cigarette sales are continuously increasing, which leaves growth in the market. As it sits right now, we're only at 5% of the market's capability for e-cigarettes, which means there is a lot of growth in that particular aspect of the industry, which Philip Morris is really trying to capitalize on. Right now, they're launching a new vape device at the end of this year. And then they're also expanding into other countries with the vape device that they're already selling right now, which is a Juul-like device, because they recently just bought out Juul. So there's a lot of room for growth, and so we believe that this company is a good buy.
And now Lauren will discuss Hershey.
Yes, so lastly, we're going to recommend Hershey as a buy to replace Hormel. They rank intrinsically higher on our model, and they have seen sustainable growth from their international business. They've also been able to benefit from 2.5% net pricing, which combats some of the growing input prices and freight and logistics expenses they've been experiencing. They've also experienced strong productivity, which was last estimated to be $100 million in 2019. They recently acquired Pirate Brands from B&G Foods in September 2018 to augment their snacking business. Also, they added Amplify Snack Brands, which was acquired in January 2018, which also is helping them gain a solid footing in the fast-growing market for snack foods, or healthy snacks in particular. They've also been on track with its Margin for Growth multi-year program, which is anticipated to improve overall operating margin through supply chain optimization, a more streamlined operating model, and reduced administrative expenses. This program has already generated a savings of $90 million so far.
So I want to just comment real quick on our list that we made these decisions to keep consistent with our diversified consumer staples portfolio. We want to make sure that we don't repeat some industries, so that's why we decided that Philip Morris will replace Yum, which was our fast food, which technically is a discretionary, but no data was available, so we weren't able to do any analysis on it. So we decided to replace it with a tobacco company that was ranked the highest in our tobacco industry, or the tobacco aspect of the industry. And as far as Hormel and Hershey goes, Hershey we just valued it as a higher intrinsic value. We saw that it would have better growth opportunities, like Lauren mentioned. And for Constellation Brands, we believe that it was a stronger alcohol beer company in comparison to Boston Beer. And Procter & Gamble and Pepsi, we believe, are still companies, and there were companies that were allocated as a whole, so we decided not to keep those companies in our current holdings. Without any further ado, I want to thank you guys for listening, and I want to open the floor for questions if you guys have any, and that's it.
How'd you come up with, early on you talked about how you weighted some factors and you gave percentages.
Yes.
I know there's a lot of art to how you come up with those weights, but how did you think about the weights that you came up with? How did you arrive?
I thought about, we did first just run it by Excel or
Yeah.
using solver, and it tells you, it allocates what the weights would give you the highest correlation.
Okay.
So based on that, it gave us a little too much allocated to EBITDA margin. So we took a little bit of that and implemented it a little more to risk and asset turnover, so we can give a more of a broader perspective on the company's fundamental value.
How did you give a score or a number? Because you're saying you weighted the risk, the entire risk section, but the risk section had like 3 or 4 different factors within it.
Yes.
Am I correct?
Exactly.
So how did you get, does that mean that all the factors within risk are weighted equally?
Yes, when you're referring to the
Yeah, so you have a score for margin
Yes.
there. How is a score for
Yes.
margin if there are 3 or 4 factors within margin that you're looking at?
It was equally
Equally
ranked,
applied?
yeah. It was
Okay.
all taken into consideration and equally ranked based on that. And that was just for us to take a look when comparing our holds and our short list. We wanted to see how overall, how do they rank on these categories, and yeah, we did it equally.
Going back, can you go back to the beta section that you had on all of your companies?
Yes, the beta.
Yeah, I think it was these. So, going back to the very beginning of this, when you guys were talking about how these tend to be companies that are less cyclical,
Yes.
right? Your betas across, from Coors, for B&G Foods, which may have its own problems,
Mhm.
and even Constellation Brands are kind of high. Did that make you question whether or not the way that you calculated those betas was best? Because I know you said you use debt to
Market cap.
debt to
Yes.
invested cap. Well, that kind of can be different for consumer staples that can take on debt. Did that make you rethink how you calculated those betas?
It did make me rethink. I do acknowledge that some of these companies do take on a lot of debt, specifically now, currently, but we just decided that we wanted to also compare it to our historical, but we just decided to go with this calculations, and
Okay.
but yeah, we did not finalize that decision as far as changing the debt to market cap to a different way of
Yeah.
calculating.
Separately, who did the grand majority of this spreadsheet work? There's a lot of not advanced, I would say, more sophisticated formulas in there than I've normally seen from college students.
It
You
was
can be honest.
what?
I was just wondering who did a lot of that. There was embedded if formulas.
Oh yeah,
and
that
someone else
was
in VLOOKUP.
myself. I'm actually typed those if formulas, and
Yeah,
I learned them before I did the model, of course, by
Yeah. like this one,
previous work. Yes, like the if formula. Yes, it was
embedded mins and maxes and ifs. Okay.
yeah, that was myself. I did it from looking at previous models and previous work,
Cool.
and I was able to implement those formulas for our
Impressive.
model this year.
Thank you.
If all of you had more time, because I know that it's a lot of work, and Professor Sweet has pointed out to us that the time constraints, and you have a lot of other responsibilities, personal and academic. So what would you have done differently, or what would you have done to extend the analysis if you had more time?
If I had more time, I would like to look more in depth at the companies on our short list, specifically their financial reports, like 10Ks and 10Qs. I would like to look at those more in depth, to look at the company's overall like health and risk factors. Is there any more additional questions? concerns. Well, with that being said, I wanna again thank you guys for taking the time to listen and thank you.
Good job.